Let's do a cash flow model on MGM Resorts. We're going to find out the intrinsic value of this company by estimating the future free cash flow and then discounting it back to today's dollars. First, let's see the market cap. So it's 7.8 billion. $7.8 billion, and then they trade at $15.85. So they have 492 million shares outstanding. So when we get the future value, we have to divide it by 492 million so we can see the stock price and see if it's a buy or not. Now the free cash flow, this is probably the most important number to look at, because this is the actual cash the company has, and every company needs cash to operate. You can't operate your business on debt alone. You have to have cash and you have to have operating capital. And free cash flow is the cash left over after operating your business. And it's actual cash in or out. When net income sometimes isn't actual, there's depreciation and other things going on, which can change net income and earnings. So I need the prior 4 years for net income and free cash flow. And you can see free cash flow went from negative 729 million in year one, then into a positive 300 million, dropped a little, and then went up to $1 billion. So it can be a little lumpy free cash flow, because if you made a big cash expenditure one year, and that might drag down your free cash flow, where on the income statement it's depreciated, that asset, so it won't be as lumpy as free cash flow. Revenue tends to be the smoothest number because there's no tricks you can do with revenue. As you can see, it slightly increases every year, which is good. But don't ever look at net income or earnings as the end-all be-all. Look into other things as well, just to make sure everything else looks correct. And this is how Warren Buffett and other investors value a company. They estimate the future free cash flow and they discount it back to today's dollars. So we're going to find out the interest they pay on their debt. So I took the interest expense of 850 million. Now I need to find out how much debt the company has. So current debt due within a year, they don't have any. And then long-term debt, they must have some. 18 billion of long-term debt. 11 billion. That's a pretty high interest rate. They pay 7.59%. They don't get good terms, apparently. And now let's see the effective tax rate. So we need income before tax. Income before tax. And then income tax. So 22%, that looks right. So even though they pay 7.59% on their debt, you have to discount it for the taxes. So it actually cost them 5.91% for the debt. And equity is generally much more expensive than debt. So to figure out the equity, we use a CAPM, capital asset pricing model, and we need that beta. They have a high beta, 2.23. It's a pretty volatile stock. So it moves 2.2 times the market. So their cap M is 19.45%. And the way we blend these together, the cost of debt and the cost of equity, is we look at the percentage of debt, 59% debt, 41% equity, and then we kind of combine those with the rates here, and then we get a weighted average cost of capital 11.47%, which is higher than most companies. And that's what we have to discount the future free cash flow by to figure out the value of the stock today. So we estimate the company is worth $8.9 billion today. Plus, that's the terminal value, plus 4 years of the estimated cash flow, and the sum of these numbers is $12 billion. That's the present value of the future cash flows. And when you divide that by the shares outstanding, we estimate the stock is worth $24.46. So according to this model, it's a buy. It's currently trading at a 35% discount. It's trading at $16 right now. Let's look at the stock on Yahoo historically. So we're saying 24. So before the pandemic, interestingly enough, it was trading pretty close. It's been trading at a premium actually for a while in the 30s, and then it dropped to intrinsic around this point, and then like everything else dropped like a rock. It hasn't come up too much since, a little bit. So it's definitely trading at a discount, but you don't just look at past performance. You have to estimate, will the company be able to operate successfully through the coronavirus pandemic? Will they be able to bring in the cash and the revenue and not need to borrow more to get through this year or two? And that's the job of you as the financial analyst to figure out. Hope you enjoyed the video. Thanks for watching.